Howdy, Jacob here. Today we're looking at the Scotts Miracle-Gro company, ticker symbol SMG. It is in the chemicals industry with a $3.3 billion market cap and a $5.9 billion enterprise value. I've seen this around, Home Depot, Lowe's, and such. They sell products for lawn, garden care, indoor, and hydroponic gardening. Revenue in 2014 was 2.6 billion, and then in 2023, 3.6 billion. And there was actually a huge jump for COVID. I assume that people wanted to tend their gardens when they couldn't go to stores and do the things that they love outside of the house. So they had the home activity of, maybe tending to their garden, and then it dropped off once they were able to go back to do other life events. We see that it is still higher than 2019, 3.6, roughly 3.6 billion in 2023 from 3.2 billion in 2019. So it's good that it is still up pre-COVID, but that is the reason that it declined so heavy. So you might have to take into consideration if the margins were also affected in the COVID, the 2 COVID years that were a huge spike. Something I don't like seeing initially, the gross margin was 34.5% 10 years ago and is down to 18.5% now. And then our operating margin is 12.8% 10 years ago, was 12.8% 10 years ago, down to 3% now. Their dividend, it looks like, has only gone up, and then I guess last year they kept it flat. But prior to the previous 2 years, very good return on invested capital, low to mid double digits, which is very likely well above their weighted average cost of capital, meaning that this business is actually increasing. They don't have to go to debt or equity to increase their revenue and earnings and such. They're able to reinvest at higher rates of return than are needed for essentially the cost of capital to keep the business afloat. There was quite a bit of debt here, though. So in 10 years ago, we're seeing 478 million in long-term debt, and now we're seeing about 2.6 billion long-term debt. Cash on hand is just 32 million. Let's see what that debt is comparison to their cash flow. So pretty volatile around here. Surprised that 2021 and 2022 had the best revenues but the worst cash flows. So that's kind of interesting to see. But right now they do have great free cash flow this year, about 441 million. If we take a 5-year average, let's say um, let's say a little over 200. So let's say a little over 200 million 5-year average free cash flow compared to debt. That's over 10 years. We do not like that. We want it to be at least under 5, preferably under the 2 to 3 range, with a healthy balance sheet there. But it does look like they make a lot of acquisitions with their use of excess free cash flow. They buy back a bit of shares, and then they pay out a pretty substantial dividend here. And so to me, it looks like the dividend they pay out is reasonable if they didn't have as much debt as they do, and they don't want to use the other excess cash flows for acquisition common stock. Because right now, you can see that their debt has increased so much. They're using over 100% of free cash flow on average every single year, and they do that by issuing debt. And so it looks like, let's say, 60 to 70% to the dividend, maybe 30%, 40% acquisition, and then 30, 40% common stock. Obviously, that's over 100%. And so anything over 100% looks like they've just been issuing in debt here. And so to me, knowing that the company uses excess free cash flow historically as well for common stock and acquisition, we don't want them to have to go to debt to use that cash for that. And especially if their long-term debt is over 10 times their average 5-year cash flow. And so to me, that's a little bit on the concerning side, to where although they can afford this dividend of 149 million aggregate payout in comparison to their over 200 million average, even though that is 70%, I want them to cut that in half, pay out about 70, 75 million in aggregate, which is going to be closer to 30% payout. And then hopefully acquisitions will be maybe 10%, common stock 10%, and then half of it just going towards flooding down the current debt situation that they have. As for the other portions of revenue increases, I feel like the 2-year super decline here isn't necessarily formidable of the business. So I'll say it grows relatively close to inflation, has a relatively close um, PE and price to free cash flow in 7 years, to where they still have a little bit of growth ahead of them. They're not necessarily a flat business. And then as for margins, I might take, before I take an average, let's see what a 2% hit would do. So 2.5 billion, let's say 2% increase of that is 50 million. A 50 million bump to their a little over $200 million free cash flow is a 20 to 25% hit. That's a pretty big hit here. So maybe I'll do 4.5, 5.5, 0% on the share change. And yeah, as expected, the price that's not quite there yet. We need to drop about 60% to get to 15% return given these assumptions. I think it could be a company we add to our dividend yield screener. It is a 4.5% yield right now. But to me, I'd want them to cut that in half and really focus on the dividend or their debt situation right now. It's very tough to personally to invest in companies with so much debt, because I've one, invested in companies and such where bad things happen, and then two, it's just you're always skeptical of what the lender is going to do, because you're obligated to pay them back or go under, and if you go under, then they sell all your assets, and you very likely, unless you're finding net companies out there, going to be getting way less than what you paid for the company. And so right now, I want them to focus on debt. I think right now I'm just waiting until it gets quite a bit lower. But yeah, I feel like there's enough to go on to where I'd be a little bit skeptical, but it's not something that's unfixable. And so the company can easily fix what's going on here, focus on the right use of excess free cash flow allocation, and go from there. But hope everyone has a good rest of their day, and thank you so much.